They lied to you. It is really that simple. And if you are not paying attention to the tape right now, you are going to be left behind in what is rapidly becoming the most vicious wealth transfer of our lifetime. You are being fed a narrative designed to keep your capital perfectly positioned as exit liquidity for institutional algorithms. Imagine waking up to the coordinated broadcast that the global energy crisis has suddenly been solved, that the ultimate geopolitical choke point has been unblocked, and that the global economy can finally breathe a sigh of relief. That is exactly what the mainstream financial media tried to violently feed you over the last 48 hours. The markets are shifting faster than ever, and the cost of being wrong is total catastrophic capital wipeout. Hello everyone, I am John A.G. and welcome back to Master Macro. If you want to survive the next economic wave and understand the real mechanics of the global money system, hit that subscribe button right now. Make sure you watch this video until the very end because the data I reveal in the final minutes completely rewrites the playbook for your portfolio. Today is Sunday, April 19th, 2026. The financial establishment told you with absolute unflinching certainty that the Strait of Hormuz, the absolute jugular of global oil transit, where 20% of the world's daily oil consumption passes, was finally open. We saw the immediate, knee-jerk market reaction to this engineered headline. Algorithmic trading systems, scanning for positive geopolitical sentiment, took the news at pure face value. Crude oil plummeted, equities caught a fleeting, desperate bid, and silver experienced a violent, sudden short squeeze, extending its gains by 5% to touch that critical $82 an ounce level. The broader market breathed a collective sigh of relief, instantly pricing in a massive de-escalation of the geopolitical firestorm that has absolutely consumed the globe over the past 2 years. But the reality unfolding right now on the dark waters of the Persian Gulf tells a drastically different, profoundly darker story. As we speak, commercial vessels are not sailing through. They are actively, frantically reversing course. Radar data, marine transponders, and classified satellite imagery confirm that maritime traffic is fleeing the corridor. The Islamic Revolutionary Guard Corps has opened fire, declaring the strategic waterway definitively and aggressively closed once again, in direct kinetic retaliation to the ongoing United States naval blockade. We are witnessing a monumental diplomatic and military breakdown in real time, and the financial media is still desperately trying to catch up to the reality that the safety of global trade routes is completely fractured. If you think this is simply a localized story about oil tankers and regional warfare, you are entirely missing the tectonic shift occurring right now beneath the surface of the global money system. What is happening in the Strait of Hormuz is merely the trigger. The real explosion is happening in the mechanics of global liquidity, fiat currency valuation, and the absolute physical constraints of hard assets. Today, we are tearing down the illusion of the traditional safe haven asset. We are looking at exactly why silver, despite the escalating military chaos and unprecedented physical market deficits, is trapped in a violently volatile tug-of-war. We must understand what the closure of the world's most critical shipping lane actually means for the future of your money, the terminal stickiness of global inflation, and the Federal Reserve's ultimate terrifying endgame. To understand the silver market right now, you have to completely deconstruct the fundamental lie that has been sold to investors for the past 2 decades regarding how precious metals are supposed to behave during a systemic crisis. The archaic textbook economic theory dictates that when geopolitical tensions erupt, when energy supplies are threatened, and when inflation expectations become unmoored, capital simply flees from risk assets like equities and floods directly into the ultimate, historic safe havens of gold and silver. It is supposed to be a linear, predictable, orderly flight to safety. But what we are experiencing right now in the spring of 2026 is the brutal, unforgiving repricing of risk in a system that is fundamentally choked by its own mathematical contradictions. We are no longer operating in the economic environment of the 1970s stagflation or even the 2008 Great Financial Crisis. We are operating in an environment where global sovereign debt levels have reached mathematical breaking points, where central banks are hopelessly trapped between hyperinflationary forces on one side and catastrophic deflationary debt collapses on the other. Let us dissect the precise anatomy of the false breakout we witnessed this week. When the headline hit that the Strait of Hormuz was allegedly open, silver rallied aggressively. To the uninitiated retail investor, this seems entirely counterintuitive. If the geopolitical risk is fading, shouldn't a safe haven asset like silver sell off? This is where you have to strip away the mainstream noise and look at the deep macro foundation. Silver has a deeply schizophrenic personality in the modern financial architecture. On one hand, it is a monetary metal with thousands of years of recorded history as a flawless store of value. On the other hand, it is the most highly conductive, indispensable industrial metal on the entire planet. By 2026, the forced green energy transition, the explosive exponential growth of artificial intelligence data centers, the relentless global production of electric vehicles, and the massive, urgent expansion of military-industrial manufacturing have completely and utterly drained physical silver inventories. Solar panel efficiency requires monumental, irreplaceable amounts of silver paste. The massive cooling systems and advanced microchips powering the AI algorithms that are currently trying to trade these very news headlines require physical silver. The global physical deficit has been widening severely for 5 consecutive years. So, when the market momentarily believed that energy prices were going to fall because the strait was open, it did not price in a loss of safe haven demand. It priced in an explosive economic boom. It priced in a resurgence of industrial manufacturing that would consume even more of an already depleted physical silver supply. The algorithmic models coldly calculated that cheaper oil means higher corporate profit margins, accelerated industrial output, and a massive spike in industrial silver demand. That is the exact mechanical reason the price shot up to $82. But then, physical reality set in. The cargo ships turned back, the missiles flew, the strait remained entirely closed, and silver's market behavior shifted instantly from a speculative industrial play back to a desperate monetary survival mechanism, caught dead in the crossfire of institutional liquidity constraints. To comprehend why silver did not simply explode to $150 an ounce the exact moment the waterway was definitively shut down, we must dive into the concept of the opportunity cost of capital and the broken mechanics of the United States Treasury market. When the Strait of Hormuz is blocked, the immediate consequence is a massive, systemic, uncontainable energy shock. Oil goes parabolic. Energy is the master resource. It is the fundamental denominator of every single economic calculation on Earth. When the base cost of energy spikes, the cost to mine, refine, transport, and manufacture every single item on the planet goes up exponentially. This absolute mathematical certainty guarantees that inflation is not just sticky, it is violently resurgent. The Federal Reserve, sitting in Washington, looks at this supply-side energy shock and realizes they are completely, hopelessly cornered. They cannot print more crude oil. They cannot lower interest rates to fix a physically broken kinetic supply chain. If they cut rates while energy prices are exploding upward, they risk completely unmooring inflation expectations and unleashing a hyperinflationary doom loop that destroys the purchasing power of the US dollar overnight. Therefore, their only available play, their only remaining mandate, is the punishing higher for longer policy. They must maintain crushing, historically suffocating interest rates to aggressively destroy consumer demand, to impoverish the working class just enough so that people stop buying goods, thereby artificially and painfully dragging down core inflation metrics. But these aggressively high interest rates are the exact mechanism that acts as a lead weight, a gravitational anchor, on the spot price of paper silver. In a high-inflation, brutally high-interest rate regime, the traditional safe haven playbook is entirely dead. Institutional capital, the massive pension funds, the sprawling sovereign wealth funds, the hyper-leveraged hedge funds that manage trillions of dollars of global wealth, are not just fleeing to precious metals for emotional comfort. They are battling a vicious, daily liquidity squeeze. When the risk-free rate on a United States Treasury bond is yielding something highly attractive in nominal terms, the opportunity cost of holding a non-yielding physical asset like silver becomes a massive hurdle for institutional portfolio allocators. They look at a pallet of physical silver, which pays zero dividend, produces zero yield, and costs a fortune to securely vault, audit, and insure. They weigh that physical burden against a digital treasury bond that pays a guaranteed nominal yield backed by the printing press of the reserve currency. As long as the broader market believes the Federal Reserve can miraculously keep this leveraged system glued together, that capital stubbornly stays in the bond market. The suppression of the silver price is not necessarily a shadowy, smoke-filled room conspiracy of mustache-twirling central bankers. It is the brutal mathematical reality of a highly leveraged, yield-starved, deeply broken financial system. Paper silver contracts are traded back and forth on the COMEX in daily volumes that absolutely dwarf the actual physical supply of the metal sitting in registered vaults. These paper derivative contracts are used as complex hedging instruments, as pledged collateral, and as aggressive speculative tools. The tail is violently, unnaturally wagging the dog. When sudden geopolitical panic hits, major institutions do not immediately buy physical silver bars. They buy short-term treasury bills for immediate, unquestionable liquid safety. They liquidate their paper silver positions to raise fast cash to meet massive margin calls in other imploding sectors of their highly correlated portfolios. This is the ultimate paradox of modern liquidity. In a true terrifying systemic crisis, the very assets you think should go up often get sold off first because they are the only things liquid enough to sell. This dynamic is rapidly reaching its absolute physical breaking point, and this is exactly where the permanent closure of the Strait of Hormuz becomes the ultimate catalyst for the final reckoning. The paper derivatives market can only dictate the price of a physical commodity for as long as the physical buyers are willingly complicit, as long as they are willing to accept paper promises instead of demanding physical delivery. What the catastrophic events of April 2026 are proving beyond a shadow of a doubt is that the sovereign physical buyers, nations like China, India, and massive multinational industrial conglomerates, are no longer trusting the paper markets of London and New York. They are quietly, relentlessly, and methodically draining the physical vaults completely dry. When base energy prices skyrocket because supertankers cannot pass through the Persian Gulf, the fundamental cost to extract a single ounce of silver from the Earth's crust also skyrockets. Modern mining is incredibly, intensely energy dependent. Diesel fuel runs the massive earth-moving excavators. Industrial electricity powers the giant crushing mills, the chemical processing plants, and the high-temperature refining smelters. As crude oil spikes, the all-in sustaining cost of global silver mining surges dramatically. Mining companies simply cannot afford to pull the metal out of the ground at the current suppressed, artificially engineered paper prices. We are seeing immediate supply destruction occurring at the exact same moment that global industrial and monetary demand is peaking at all-time historic highs. This creates an unbridgeable, fatal chasm between the artificial digital paper price and the actual, undeniable physical reality. The financial illusion is shattering before our very eyes. The massive cargo ships turning back in the Middle East are not merely a symptom of a localized geopolitical crisis. They represent the fatal, unrecoverable blow to the global just-in-time supply chain model that has kept consumer inflation artificially suppressed for the last 3 decades. We must look deeper into the psychological shift happening in the global currency markets, because silver is, at its absolute core, a decentralized currency that cannot be printed by any government decree. For decades, the entire global financial system has been flawlessly underwritten by the petrodollar agreement. Global oil was priced exclusively in US dollars, ensuring a constant, massive, synthetic global demand for the American currency. But the military blockade of the Strait of Hormuz and the permanent fracturing of historic geopolitical alliances are rapidly, violently accelerating the de-dollarization of global trade. Sovereign nations that are hostile to the United States or simply terrified of being financially weaponized and cut off from the SWIFT system are aggressively bypassing the dollar entirely. They are settling massive multi-billion-dollar energy trades in local fiat currencies, in physical gold, and increasingly in critical commodities. As the US dollar loses its absolute, unquestioned monopoly on global energy pricing, its fundamental macroeconomic value proposition weakens permanently. The Federal Reserve is forced into an impossible, no-win corner. They must either keep interest rates astronomically high to protect the dollar's exchange value, which rapidly bankrupts the United States government due to astronomical, compounding interest payments on the $34 trillion national debt, or they must lower rates to save the collapsing domestic economy, which instantly crushes the dollar and causes imported inflation to go absolutely parabolic. This is the textbook definition of a sovereign debt death spiral. And in a sovereign debt death spiral, hard, tangible assets with absolutely zero counterparty risk are the only true financial lifeboats. Silver is not just an industrial commodity, it is a vital monetary lifeboat sitting quietly in the shadows of its more famous cousin, gold. But unlike gold, which simply sits in central bank vaults collecting dust, silver is being actively consumed, burned up, and permanently discarded in microscopic amounts in every single technological device we manufacture. It is actual historic money that is being destroyed at an industrial scale every single second of every single day. As we navigate this deeply treacherous landscape of 2026, you have to realize that the geopolitical theater playing out on your news feeds, the flashing red and green lights on your trading screens, is just the surface noise designed to distract you. The real war, the silent war that dictates your standard of living, is being fought right now in the obscure plumbing of the bond markets, the opaque currency swap corridors, and the very foundation of global institutional liquidity. When you see a breaking headline claiming a massive crisis is magically averted, you must step back and ask yourself who financially benefits from that specific narrative. The algorithmic flush that drove oil down and silver momentarily up was a perfect crystalline example of a broken market reacting to a manipulated headline rather than the underlying physical truth of the world. The undeniable physical truth is that the world is structurally permanently short of cheap energy and structurally permanently short of above-ground physical silver. No amount of Wall Street financial engineering, no amount of complex paper derivative creation, and absolutely no amount of dovish central bank rhetoric can print a single barrel of crude oil or magically mine an ounce of silver out of thin air. The entire global economy has relied on a delicate, perfectly synchronized, highly leveraged ballet of maritime trade to keep the wheels of modern commerce turning. The Strait of Hormuz is the central, unavoidable stage of that ballet, and the music has just violently, permanently stopped. The disruption of this specific, irreplaceable supply chain sends a cascading, destructive bullwhip effect through the entire global manufacturing sector. A delay of just a few weeks in base energy and raw commodity shipments creates absolute chaos in the tightly wound industrial production schedules of Europe and Asia. This forces multinational companies to aggressively hoard raw materials out of sheer panic, drastically exacerbating the already critical supply deficits. It becomes a vicious, self-fulfilling prophecy of absolute scarcity. Furthermore, we must critically examine the diverging behavior of the retail investor versus the sovereign wealth fund. For years, retail investors have been diligently stacking physical silver, deeply frustrated by the obvious manipulation of the paper price. They have been repeatedly told by mainstream financial advisors that they are wrong, that silver is a useless, barbarous relic, that volatile digital assets or mega-cap tech stocks are the only acceptable way to build wealth in the modern era. But the massive sovereign wealth funds, the apex central banks of the BRICS nations, have been watching the exact same macroeconomic data. They clearly see the exploding, unsustainable United States debt issuance. They see the aggressive weaponization of the reserve currency, and they see the structural, unfixable deficits in hard, tangible assets. They are not buying paper silver exchange-traded funds. They are not playing the COMEX casino. They are buying raw, massive physical bullion, completely bypassing the Western exchanges and taking direct physical delivery into their own sovereign vaults. They are actively, aggressively establishing a parallel financial architecture completely backed by tangible, essential commodities. The permanent closure of the Strait of Hormuz drastically accelerates this historic transition. It forces sovereign nations to violently secure their own supply chains and rely far less on the fading United States naval umbrella to protect global free trade. It signifies the definitive, undeniable end of the unipolar globalized world and the terrifying return to a multipolar, highly fragmented, and deeply inflationary geopolitical world order. In this new, ruthless world order, whoever holds the physical commodities dictates the terms of survival. Trillions of dollars of paper wealth, backed by nothing but the empty promises of hopelessly indebted governments, will inevitably and violently be repriced against the harsh physical reality of energy and industrial metals. You need to deeply internalize the sheer magnitude of the data that the broader stock market is currently choosing to completely ignore. The COMEX registered silver inventories, the actual verified silver that is mathematically available for physical delivery, have been hovering at historic, dangerously low levels for months. The ratio of digital paper claims to every one single ounce of physical silver sitting in the vaults has stretched to a point of pure, undeniable mathematical absurdity. The entire pricing system is operating on fragile, fractional reserve dynamics, praying every single day that not everyone asks for their metal at once. But the sheer panic induced by the massive shipping crisis in the Middle East is exactly the kind of black swan catalyst that breaks a fractional reserve system in half. When massive industrial manufacturers realize that the digital paper contract they hold might not actually guarantee delivery of the physical silver they desperately need to keep their billion-dollar factory lines running, they will panic. They will immediately demand physical delivery. A historic, unprecedented run on the physical vaults will ensue. This is not a matter of if, but exactly when. The immense pressure is building rapidly underneath the surface, constrained only temporarily by the artificial, fleeting strength of the dollar and the Federal Reserve's iron, white-knuckled grip on interest rates. But that grip is visibly slipping. The sheer math of the global debt burden is completely undeniable. Trillions upon trillions of dollars in sovereign debt are rapidly rolling over at much higher punitive interest rates, aggressively sucking productive capital out of the real economy and forcing bankrupt governments to print astronomical amounts of new currency just to pay the interest on the old debt. This is the exact historical definition of a fiat currency endgame, playing out live on our screens. This brings us to the most crucial immediate piece of data, the shifting dynamic that you must pay absolute attention to right now. While the mainstream media is purposefully distracted by the day-to-day fluctuations of the stock market and the endless political theater in Washington, the real smart money is quietly, aggressively positioning for the inevitable, violent break of the paper-silver market. We are currently witnessing unprecedented volumes of physical offtake directly from the global refiners. The premium you must pay over the spot price for physical bullion coins and industrial bars is beginning to severely decouple from the spot price dictated by the futures market. This physical decoupling is the ultimate screaming warning siren. It tells you unequivocally that the market mechanism for accurate price discovery is completely broken. When you cannot actually buy the physical metal for the price quoted on the digital screen, the price on the screen is a total fiction. The massive ships turning back from the Strait of Hormuz today are going to drive maritime shipping insurance premiums to astronomical, prohibitive levels. Massive cargo ships will be forced to take the long, arduous, incredibly dangerous route around the Cape of Good Hope, adding weeks to critical delivery times and burning millions of gallons of expensive extra fuel. This guarantees mathematically that the base cost of every single imported good is going to rise sharply. It guarantees that the core inflation metrics the central banks desperately monitor will re-accelerate aggressively. And when inflation undeniably re-accelerates, the massive global bond market will violently revolt. Treasury yields will spike uncontrollably, forcing the Federal Reserve into an impossible historic choice. They can let the bond market completely collapse, taking the entire heavily leveraged financial system down with it in a deflationary depression. Or they can step in and buy the bonds with newly printed trillions, admitting total defeat on inflation and unleashing a spectacular, historic devaluation of the currency itself. When that precise moment arrives, the massive tsunami of global capital seeking a safe lifeboat will not be able to physically fit into the tiny, constrained physical silver market. The exit door is incredibly small, and the amount of panicked, trapped capital is unimaginably large. The inevitable repricing will not be a slow, steady, orderly climb. It will be a violent, vertical, historical revaluation. The desperate industrial users will be forced to bid against the panicked monetary safe haven seekers, creating a perfect, uncontainable storm of massive demand against an inelastic, rapidly shrinking physical supply. The events unfolding exactly today, on April 19, 2026, are not an isolated geopolitical skirmish that will be resolved next week. They are the undeniable, terminal symptoms of a global financial system hitting the absolute physical limits of its capacity. The long-standing illusion of endless cheap energy, the illusion of perfectly functioning, uninterrupted global supply chains, and the fatal illusion of paper wealth are all shattering simultaneously in real time. The violent tug-of-war in the silver market is the absolute physical manifestation of this global reckoning. You must look far beyond the daily manipulated headlines. You must profoundly recognize the difference between a digital paper derivative and a hard physical asset in a world that is rapidly running out of trust. The geopolitical theater will keep dominating the nightly news cycle to keep the masses distracted, but your absolute financial survival depends entirely on understanding the raw mechanics of the money system beneath it all. The markets are going to severely test your conviction. They are going to aggressively shake out the weak hands with violent engineered volatility. But the fundamental, undeniable mathematics of physical supply, industrial demand, and inevitable fiat currency debasement remain absolute. The math cannot be altered. Prepare your portfolio and your mindset accordingly, because the extreme volatility we have witnessed so far is merely the opening act to a much larger, historically unprecedented economic realignment. I am John A.G., and until next time, keep looking beneath the surface.